This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Don't look now. The Nasdaq is at its highest level since March 2000, just around the time the dot-com boom went bust. But today's index is a lot different.
Divorce in aisle 9. After 16 years together, Costco ditches American Express, and the stock suffers a big blow.
Economic ripple as Congress calls for a resolution. A new report puts a number on the amount of economic activity tied to those West Coast ports, and it's big. All that and more tonight on Nightly Business Report for Thursday, February 12th.
Good evening, everyone, and welcome. Stocks rally. The S&P closes in on a record. The Dow Jones Industrial Average sees a triple-digit gain, but we begin tonight with the Nasdaq, powered today by a 9% move in Cisco, a deal in the online travel industry, and chip stocks like Nvidia and, of course, Apple. The index is now approaching that famous or perhaps infamous level of 5,000. The number is synonymous with the dot-com bubble that peaked 15 years ago in March of 2000 and went bust fast. But the technology sector is a lot different now than it was back then. Bertha Coombs takes a look.
Healthcare tech firm Inovalon's IPO at the Nasdaq market site today is representative of what is fueling the new boom in the Nasdaq composite. Investor appetite for new tech stocks has helped push the index within 5% of its all-time internet bubble high in March 2000. But at the risk of sounding trite, analysts say this new tech boom is different.
In 2000, you had this parabolic move in the Nasdaq that was following the tail end of this 15-year secular bull market. And now, on the other hand, it's been a much steadier, healthy move into 5,000 on what we see as the early stages of a new secular bull market.
Among the biggest differences, biotechs are now the biggest drivers of gains, up 35% in 2014, as companies like Gilead have brought big drugs to market. Another big difference, tech valuations. Microsoft, the biggest weight in the Nasdaq index 15 years ago, traded at 70 times earnings. Today, Apple, the biggest driver, is valued at 14 times its forward earnings after posting the highest quarterly profits of all time.
I see this as a change in that consumers are spending more on tech versus enterprise. Microsoft was mainly selling to businesses. Now Apple's obviously a very consumer-focused company, and we're all basically spending more money on our gadgets.
While the S&P 500 and the Dow Industrials continue to set new records, the Nasdaq Composite has yet to take out that milestone, with big tech stocks like Microsoft, Cisco, and Intel well off their internet bubble highs. Is the Nasdaq return to 5,000 a reason for tech investors to take pause?
Given really the broad-based leadership that we're seeing throughout the market, I think a breakout above 5,000 would only lead to stronger gains for tech stocks.
From a growth perspective and fundamental perspective, I don't see it being a top at any reason now.
The number to watch on the Nasdaq is 5,048. That was the closing high on March 10th, 2000. The intraday high that day was 5138. From the Nasdaq market site, Bertha Coombs, Nightly Business Report.
So will it be old tech or new tech that gets the Nasdaq to the next level? Let's ask Brian Blair. He's managing director with Rosenblatt Securities. Brian, welcome. Good to have you with us. It was an interesting day today. Cisco had a very nice day after its earnings. I call that old tech. Tesla had a rough day after its earnings. I call that new tech. It's too easy to write off some of those old tech companies, isn't it?
It is. One of the reasons is because they have, large buckets of cash, and they're throwing a lot of money into R&D and finding ways to grow and stay relevant now. And the best ones are throwing money into what they believe will be the trends of tomorrow. But a lot of those companies, Cisco, Microsoft, still fighting, still staying relevant.
So where do you find the most opportunity? A lot of people thought it would still be biotech this year, but we have seen some of the biotech stock kind of roll over after massive IPOs last year. Where do you still see opportunity?
There's still a lot of opportunity in the mobile sector. Smartphones are still only about 55% of the global handset market. And so if you think about it, you think about the global market, there's still a lot of opportunity to ride the wave of India getting the smartphone, the rest of China getting 4G. South America, Central America moving on to 4G networks. So that's one big area. And I still think the internet itself provides a lot of opportunity. I think there's only about 2.5 billion, maybe still less than half the world's population has internet access. So I think there's still opportunity there as well, I think for years to come.
I don't know whether to call Apple old tech or new tech. I would just call it good tech. But as we look at the classic old tech companies, the Intels, the IBMs, the Microsofts, the Ciscos, which of those would you call the ones that are the Oracles even, which would you call the most vulnerable or unprepared for today's new world, and which would you call the ones that are best positioned?
I think Intel actually represents one that's very vulnerable, and I think one that represents in many ways old tech. If you think about a lot of the most important trends in technology, a lot of them related to mobile, to smartphones, to tablets, to wearables, which is a new and emerging space. You don't see Intel. You really don't see Intel anywhere. And that's where a lot of the growth and the volume has been in the last 10 years, and Intel's been virtually non-existent. Now, they still sell into desktops. They still sell into servers. So they are still able to put up a nice quarterly number, but they're not participating in the growth or where I think that, where things are moving directionally. So I would put them on the top of the vulnerability list in terms of old tech. IBM is another one that has been struggling. We've seen them make comments about investing to try and be a part of big data, the big data trend, cloud computing, but we don't see it really reflected in their numbers. And so I would put those two on the top of the vulnerable list. On the good list, Microsoft, I think, is really impressing in a lot of ways with the way they're looking at the future, not just with what they're doing in Xbox, but they showed a new virtual reality headset called HoloLens that really is very forward thinking. I think they're definitely looking ahead, and they're definitely in front of things. All right. I would separate them like that.
All right, Brian, thank you very much. Appreciate the answer. Brian Blair with Rosenblatt Securities.
You bet.
One Dow component that wasn't up with the rest of the market was American Express. In fact, it was down quite a bit. Shares lost more than 6%, the Dow's worst performer today, after Costco said it would stop accepting American Express credit cards at its U.S. stores. Dominic Chu is joining us now. And how important is the relationship between Costco and Amex?
It's huge. And the reason why, Amex says that you could expect to see earnings and sales weighed down by this relationship ending over the next couple of years, because believe it or not, the estimates are that about 8% of all spending on American Express cards comes at Costco U.S. locations.
Really?
That's how big it is. Now, Costco is huge. They sell a lot of stuff. The National Retail Federation says they're the world's second biggest retailer in terms of total revenues. They sell a lot of stuff. And right now, over the past 16 years, the only ways that you could pay at a Costco were cash, debit card, or an American Express. And then they linked the Amex to their membership, meaning that you could have an Amex card linked to your actual membership, and that's the reason why it's such a huge
So
deal.
when will this, they were negotiating, they've broken it off. Apparently Amex has lost the deal with them. When does the deal end, and when will that revenue stream stop for them?
March of 2016. So you can continue to use your Amex card until March of 2016. At that point, they're going to be looking for a new replacement. Of course, the negotiations are ongoing between Costco and any potential partners. The big deal is Amex's relationship in Canada with Costco ended this past year as well. They went with Capital One on a MasterCard basis. So that's one of the things that people are looking for. Who's going to replace Amex? Could it be Capital One? Maybe it's Discover. Maybe it's another bank using a Visa or a MasterCard payment processor. That's going to be a big deal.
All right, Dom, thanks so much. We appreciate it. Dominic Chu.
All right, despite the fall in American Express, stocks did finish the day higher, helped by a ceasefire deal between Russia and Ukraine, along with higher oil prices. All three major indexes ended in the black for the day. The Dow up 110 points. It finished at 17,972, just a few points shy of 18,000. Nasdaq up 56. The S&P gained about 20.
And more now on that ceasefire between Russia and Ukraine that helped to ease investor concerns, since any more trouble in that region could weigh on Europe's economy. But not all of those issues between the nations were ironed out. Julia Chatterley reports from Brussels.
Cautious optimism from EU leaders, I think, here leaving this meeting about the peace deal signed between the pro-Russian separatists, Russia and Ukraine. I think the fact, though, that the talks took 17 hours into the early hours of this morning underscores two important points. One, ultimately that they were pretty tough negotiations, and two, the desperation of the leaders behind them just to get something signed today. But the billion-dollar question now becomes, will all sides abide by the ceasefire agreement that begins at midnight on Sunday? There's plenty of skepticism here behind the scenes, given what we've seen in the past, and for that the spotlight now falls firmly on Russia. There were no talks here today about further sanctions, but I think the message is that pressure will remain and that actions speak louder than words. We've left a lot of these meetings bemoaning the fact that EU leaders can't agree on further sanctions on Russia, perhaps that overshadowed and offset today by the announcement of a collective $40 billion bailout for Ukraine. But behind the scenes, no illusions of the difficulty of reforming a country that is, for all intents and purposes, at war. For Nightly Business Report, I'm Julia Chatterley in Brussels.
On to the rapidly changing situation in Greece. Last night, we told you about reports that an agreement in principle had been reached between Greece and its Eurozone creditors, but that quickly fell apart. Michelle Caruso-Cabrera tells us now what went wrong and what might come next.
It was a night of high drama. Many participants in yesterday's meeting believed that they had reached a broad agreement in principle with Greece. The details to be hammered out at another meeting this coming Monday. But at the very last minute, Greek Finance Minister Yanis Varoufakis refused to sign the draft statement that they were supposed to release to the public, saying he couldn't sign it after putting in a call to Athens. Despite that high-profile breakdown, Greek stocks moved higher today anyways. Market participants focusing on a leaked draft of what Mr. Varoufakis was supposed to sign, and it showed that the Greeks had made concessions that were unexpected. The draft statement referred to exploring, quote, the possibility of extending and successfully concluding the present program. That's something Greece previously said it would never do. And it's seen as a crucial step, though, in order to get continued support for their banks from the European Central Bank. Also adding to the optimism, a German newspaper reporting that the ECB had agreed today to extend even more loans to Greek banks through an emergency lending program. In one way, this is bad news. It shows that the banks in Greece are still under stress. On the other hand, market participants say it shows the ECB is still willing to support the country. All of Europe's finance ministers meet again for another negotiating session on Monday. That day will be key to see if they really can get a solid deal hammered out. For Nightly Business Report, I'm Michelle Caruso-Cabrera.
Still ahead, negotiations at the West Coast ports are strained, and now members of Congress say they're very concerned. A big miss for retail sales for the second straight month. Sales fell a more than expected 0.8% in January. Now, part of the reason can be explained by the fall in gas prices, which lowers receipts at service stations. But as Steve Leisman reports, that's only part of the story.
A disappointing retail sales report for January, sparking an economic mystery. If Americans are saving more on cheap gasoline and making more because the nation added 1 million jobs over the past 3 months, where's the money going? Rather than the 0.5% decline expected by Wall Street, the government said spending in America's shops fell nearly a full percentage point in January. There was an expected 9% plunge in gasoline station sales, but sales were also off at department stores, furniture outlets, and auto dealerships. Did the extra greenbacks just vaporize? Well, that's not the most likely explanation. Rather, economists on the case theorize more money is being saved and used to pay down debt. A recent Visa report found consumers hanging on to roughly half of their gas savings. Some of the money could be going to services, which accounts for 2/3 of all consumer spending and is not counted in the retail goods report. Service spending would include increased spending on health insurance. But there's another solution to the mystery: inflation, or in this case, deflation. The numbers the government reports are not adjusted for changes in prices. If prices fall, Americans could be buying the same amount of stuff, just spending less for it. So when the government reports inflation-adjusted or real spending when it calculates GDP, spending could show a gain. Case solved? Not quite. Optimists aren't ready yet to assume consumers won't spend the gas windfall, and they think the real evidence will come in the months ahead when the mystery of the missing money is solved at cash registers around the nation. For Nightly Business Report, I'm Steve Leisman in Dallas.
A big threat to the economy is the slowdown at the West Coast ports. According to Guggenheim Securities, the L.A. Long Beach port alone accounts for nearly 40% of the country's containerized trade, and it's estimated that 12.5% of U.S. GDP is tied to cargo moving through those West Coast ports. Now, as we told you last night, work has been suspended again, this time for 4 days. Jane Wells has more.
On Thursday, more than 40 container ships were either anchored off the West Coast or were circling, waiting for anchorage space, as work loading and offloading ships again came to a standstill.
Do not listen to PMA's Stay united.
That's how strained negotiations have become between shipping lines and terminal operators against the union representing longshoremen. With cargo backed up, the Pacific Maritime Association, or PMA, representing employers, said there was no point in hiring crews to work vessels, especially since Thursday, Lincoln's birthday, would require higher pay, as much as $92 an hour for the most senior foreman. The same pay goes for this weekend and Monday, President's Day, so no ship work then either, as the PMA calls the congestion, which it blames on dock workers, a strike with pay.
Every time we solve an issue that is important to the union, they layer on new demands. The latest one we can't live with.
According to management, the demand it cannot live with is one by dock workers to be able to unilaterally fire arbitrators. While the U.S. economy could suffer as goods take weeks longer than normal to move in and out of the West Coast, Congress is worried.
Well, this is clearly the greatest threat our nation faces, notwithstanding the stuff that's gone on overseas.
There would need to be a complete strike or lockout for the president to be able to force a cooling off period and reopen the ports under the Taft-Hartley Act. Instead, there are only partial lockouts on ships. Work is supposed to continue moving containers out of the yard. And as for negotiations, which started last May,
We've been sitting here as I give this speech for 5 days waiting for PMA, and they haven't shown up yet.
the PMA says negotiations were resuming today. And the reason that it hasn't met with the union at all this week is because it says there has been no point, that while management has offered concessions, the dock workers, quote, won't budge. For Nightly Business Report, Jane Wells at the Port of Los Angeles.
The impact of the slowdown is already being felt. According to Goldman Sachs research, shippers have diverted cargo away from the West Coast ports, even at the expense of increased freight costs. And that's leading to a decline in intermodal volumes for companies like BNSF and Union Pacific. Retailers also rerouting shipments using air freight, and that is helping companies like FedEx and UPS.
We begin our market focus tonight with disappointing results from AIG. The insurance giant saw its profits slide, hurt by weak performance in its corporate category. The company did announce a buyback, about $2.5 billion worth of shares, which adds to the nearly $5 billion in stock that it bought back last year. It also declared a dividend of about 12 cents a share that has a yield of about 1%. After the bell, the shares were volatile. Before the close, the stock was up 20 cents to $52.45. It was the opposite story for CBS, which also reported after the close. The Tiffany Network reported better than expected revenue on higher ad sales, helped by Thursday Night Football and the ads for the midterm elections. That sent shares initially higher in after-hours trading. Before the close, the shares were up nearly 2% to $57.77. Inflation in Brazil and a stronger dollar took a bite out of Avon's overseas revenue. The cosmetics maker's results missed analyst estimates on both the top and bottom lines. The company said those currency fluctuations will continue to weigh on performance this year, as it does most of its business outside the U.S. But Avon also told investors it expects its North American business to turn profitable for the first time in 3 years. Shares rose more than 1% to $8.69.
Well, Kellogg still has the breakfast blues. The cornflakes maker posted a big quarterly loss, cut its forecast for long-term annual revenue growth as cereal sales continue to be quite sluggish. Shares fell 4.5% to $63.30. Apache also posted a quarterly loss as it wrote down the value of its oil and gas assets, revenue lower than expectations also, and it announced it is slashing its rig count by more than a third in response to crumbling crude prices. The stock down slightly to $64.58. And Time Incorporated gave investors a weak sales outlook for 2015 that weighed on shares in today's trade. This is the publisher of magazines like People and Sports Illustrated, reported a lower than expected quarterly profit as it's been dealing with falling circulation and lower ad revenue. Shares off almost 2%. They settled at $24.49.
Expedia is on a shopping spree. Its latest acquisition, Orbitz, just a few weeks after buying Travelocity. The deal is valued at more than $1 billion, and it will help the new company take on bigger rival Priceline. Orbitz soared on the news, as did Expedia. Simon Hobbs takes a look at how this deal changes the global online travel industry.
Orbitz is one of the smallest online travel agencies and would have struggled in the future against the growing market power of giant rivals Expedia and Priceline, who spend billions on advertising a new technology. So, as the saying goes, if you can't beat them, join them. Expedia already boasts 13 major brands. For $1.6 billion in cash, Expedia's CEO, Dara Khosrowshahi, can now add the Orbitz brand and the Orbitz-owned cheap tickets, e-bookers and hotel club. Those four, he says, will be much more profitable once he's cut $75 million in cost and gives them access to Expedia's big stockpile of hotel rooms for sale.
We've got one of the broadest global inventories out there, and we think that the complement of that inventory to the Orbitz loyalty program, the bank programs that Orbitz has, we think that's going to be a terrific combination.
The CEO of his target at Orbitz, Barney Hartford, is well respected. Over the last 2 years, he's reinvigorated the business with better technology and a private label business, essentially running the back office for ad hoc sites like Amex Travel. But ultimately, without the power of Expedia and Priceline to bid in real time for your and my business, he went for a trade sale.
People may have tried to write us off in the past, but I think they see our continued and ongoing growth really showing through.
It was what remains of Travelocity that Expedia bought 3 weeks ago for $280 million. Trivago cost Expedia well over $600 million. But rival Priceline's deals are even bigger. OpenTable for $2.4 billion and Kayak for $1.7 billion. Despite the consolidation, Dara Khosrowshahi rejects the idea that there's a lack of competition or that the regulator should get involved.
We compete in a much larger segment in general, and there's lots and lots of competition for that top audience.
And for travelers shopping online, the CEO of Expedia promises that all 17 major brands will operate with an independence that ensures there's still a deal to be had, even if they're still all owned by the same company. For Nightly Business Report, I'm Simon Hobbs at the New York Stock Exchange.
Coming up, what some local florists are doing to keep business from wilting as competition increases and as Valentine's Day approaches.
Business is blooming for the flower industry, but not necessarily for your local florist. Increased competition and online delivery companies are pinching many small business owners. But as Kate Rogers reports, some old-fashioned mom-and-pop shops are finding an edge in order to battle back.
This year, more than $2 billion will be spent on flowers for Valentine's Day alone. But local florists like Caldwell Flowerland in New Jersey are seeing increased competition and in some cases losses. That's because of big e-commerce players like 1-800-Flowers, FTD, and Pro Flowers. In fact, local florists saw their revenues slide nearly 40% last year, according to IBIS, a market research group. Flowerland, in business 30 years, has also seen its revenue fall. But owner Frank Delasanti says there's been a silver lining.
It took a little dip, but it also educated customers where to come back to. So it also weeded out a lot of other competitors too.
Any way you spin it, there are more options than ever. A new crop of startups are blooming in the flower delivery space. AngelList named 30 of them, including Urban Stems and Bloom That, which deliver bouquets on demand within an hour or so. Even Whole Foods is getting in on the action, partnering with grocery delivery startup Instacart in 15 cities. Then there are the supermarkets and big box stores like Walmart. Analysts say they could be even more detrimental to local florists than e-commerce. Delasanti says he has one thing, though, that big box stores are missing: a personal touch.
Yeah, we try to keep an all year round price, and then we try to keep it consistency and quality.
Business here at Flowerland is still pretty good. In fact, they'll sell about 10,000 of these roses over the Valentine's Day holiday weekend this year. But increased competition from other e-commerce players in this space has hurt other local florists around the country, some of whom have had to close their doors for good. For Nightly Business Report, I'm Kate Rogers in Caldwell, New Jersey.
Kate got the rose from The Bachelor. Finally tonight, 3 people defied the odds and won the $564 million Powerball jackpot. 2 of them are not are sitting here tonight because the tickets were sold in Texas, North Carolina, and Puerto Rico. That's the first winning Powerball ticket ever sold outside the continental United States. If the winners choose the lump sum option, the 3 would split $381 million before taxes. We're both here, Sue.
I know, which means we didn't win. But if you're watching, you probably didn't either. So come on back here tomorrow night, right?
That's right. We'll see you back here. You're having a couple of days off. I'll see you when you get back.
Okay, thanks. That's it for Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Mattson. Have a great evening. We'll see you back here tomorrow.